In this video, we're going to talk about discount points when obtaining a mortgage. So discount points are essentially prepaid interest that you give to the lender. And I just want to clarify that we're not talking about any points paid on loan origination in this video. That's something separate. What I'm talking about is prepaid interest, and the way it would be calculated is, for example, 1 point. So if you offer 1 point to the lender, you're basically giving 1% of the loan's value, right? So 1% of loan value. So let's say it was a $100,000 loan. You're offering to pay the lender $1,000 up front. Now that does not go toward the principal, right? It's just based on the principal that we calculated, just a percentage of the principal, but it's actually prepaid interest. Now, in exchange, so what you might be wondering, why would I prepay interest? Why is this beneficial for me to do? In exchange for this 1 point, for example, the lender will give you a reduction in your interest rate. So you'd get like for example, a 0.25% reduction in your interest rate. So let's say that your interest rate was 6.75% with no points, and you say, you know what, I'll give you 1 point. You're giving the lender $1,000, and in exchange, your rate is going to go to 6.5% for the life of the loan. So that's what discount points are. Might be a little easier for you to understand if we walk through an example, and you can kind of see how it would play out. So let's say that you have on the table, you're ready to buy a home. You've got a 30-year mortgage for $160,000. This is the amount of the loan. This is the loan value. And it's 7% interest the lender has quoted you. Now the lender says, look, I'll reduce this interest rate, this 7% interest rate, by 0.25% per discount point. So now let's say that you're saying, okay, you know, I could offer 1 discount point, I could offer 2, and so forth. Let's just say, for the sake of this example, let's say that you offer 2 discount points. So let's say 2 discount points. And then let's just take a look at how we would calculate that and how it would affect the loan. So first off, I probably should have noted here, so that for these terms, for a 30-year mortgage, $160,000 at 7% interest, you would have a monthly payment, and this is rounded, of $1,064 a month. So this would be your monthly payment. That's going to come in handy momentarily. So right now, so let's say this 2 discount points. How do we calculate what we're paying the lender? Because it's prepaid interest, right? So we have to make a payment to the lender up front. So what we do is these 2 discount points, we're going to say right here, that will be 2%, because there's 2 points, right? If it was 1 point, it would be 1%. 2%, and then we're going to multiply that by the loan, right? So $160,000. So 2% times $160,000. And what is that going to give us? Change colors here. That's going to give us $3,200. So we're going to prepay, assuming that we do this, we're going to prepay $3,200 to the lender. I want to make sure this is clear. Now again, this is not saying, oh, okay, well now we owe, you know, $160,000 minus $3,200. That's not how it works, right? This is not reducing the principal, right? So this is interest is not affecting the loan balance. So this is what we're doing for the lender. Now, what is the lender doing for us? Well, they're going to reduce our rate by 0.25% per discount point, right? Now, we're giving them 2 points. So that means 2 times 0.25%. And so what is that going to be? It's going to be 0.5%. So our interest rate is going to go from 7%, and now we're going to have an interest rate of 6.5%. And I'll just put here, that's our new interest rate. Now we can go ahead and calculate a new monthly payment. And the reason for that, let me just go. So now up here we have enough information to calculate our monthly payment, and we calculated $1,064, right? But our interest rate has changed. So one of the inputs to calculating the monthly payment has changed. So now, because we have a lower interest rate, we're going to have a lower monthly payment. So now, let's see how much. So our new monthly payment, so I'll put here monthly payment, is going to be, and I just rounded this, $1,011 a month. Right? So that's the new payment. Now you see, if we go back to our other payment, we've got 1,064 versus 1,011. So there's a difference of $53 there. So put it this way: we're paying $3,200 up front to save $53 a month. So how would we go? Let's see. I really want to make sure this is clear. So, let me change colors again. Pay $3,200 up front to save $53 a month. So, if we want to say, is this a good deal for us? Should we give the lender the 2 discount points, or should we say, no, we don't want to do that? Well, there's a really simple way that we can calculate whether this is going to be beneficial to us, because it's going to depend on how long we decide to hold this or to own the home, right? If we decide we want to sell or refinance, that's going to change things, right? And I'm going to explain why momentarily. But let's just say, okay, so we're paying $3,200, but we're benefiting $53 a month. So if we take that $3,200 that's being paid and we divide it by $53 a month, that's going to tell us how many months that it's going to be before we break even, right? So I'll even just put that here, months to break even. And by break even, I mean we're indifferent whether we lose money or gain money. So we can figure out how many months we would have to have this loan before we'd actually break even, and then after that month we start to actually make money and it'd be a good deal for us. So if you take $3,200 and divide it by $53 a month, you're going to get 61 months. Now it's like 60 point something, but if you did 60 months, then you'd be losing money. So you have to do it the 61st month is when we break even. At that point, now, and then let me just say, in 61 months, you might think of that as 5 years and 1 month. That might be a little easier for you to think about it like that. So if we take out this loan to buy this house and we give the lender 2 points, we're paying them $3,200 up front to get a cheaper monthly payment of $53 cheaper. And if we own this house for longer than 5 years and 1 month, that will become a good deal for us, right? Because at that point, the savings have accumulated enough, right? So if you think about it, for example, if we multiplied this 53 by, let's say, 100 months, right? So then we'd have, this is just an example. So let's say, here, let me make sure to make this really crystal clear for you. So we had $53 a month that you save, and then let's say it was multiplied by 100 months, which is greater than the 61 that we're talking about here. I'm just trying to make it easier for you to understand. That would be that we save $5,300, right? So then you just think about it like this. Well, we paid $3,200, and assume you're going to hold this for 100 months, then that's $5,300. So $5,300 is larger than $3,200, right? So basically, this point right here, the 61 months, that's the point where, okay, if we plan to own this home at least this long, then it would be advantageous for us to pay the points. However, if you are thinking, you know what, I think I'm going to sell this house in 2 years. I don't plan on living here that long, or I might want to refinance. In that case, this $3,200 that you're paying up front is not enough. You're not. This $53 a month savings is not compensating for the amount of money that you're giving to the lender up front.